All right, hello, everyone. Welcome to today's weekly market check-in with myself, Greta Wall. I'm your host, and I'm joined by Derrick Oldensmith, a professional prop trader with T3 Trading Group and the leader of T3 Live's Pro Desk virtual trading floor. Real quickly, here's a look at Derrick's positions as of 12:30 p.m. Eastern Time today. Lots of longs on in this market, so we'll be talking about that and how you're managing that. But Derrick, happy Monday. How is your day going so far today?
It's going all right. I had some long swings over the weekend that obviously I'm down some P&L on, but despite the large gap down this morning and the initial sell-off, I was a big buyer into that. So I've made a lot of P&L back from where I was this morning when I first logged in the computer, which is great. And maybe by the end of the day today, I'll find myself green. I'm certainly working on it.
Yeah, good. All right. So the title of our live stream today is Tariff Scare. And ultimately, the markets definitely were scared of the latest on the tariffs this morning. As you mentioned, had a huge gap down into the open today, but clawed back quite a bit here. The NASDAQ still down over 1%, but the S&P 500 only down about 1/3%. Dow is green. So definitely a different market than I was looking at when I titled this live stream at 6:30 this morning, my time. So the reaction this morning, let's talk about it quickly. A lot of the tariff news is Trump saying, reciprocal tariffs will start with all countries, and he's rejecting the narrower launch down to, just a few different countries. Do you think for the market, this reaction this morning was just uncertainty about what we're looking at 2 days from now? Because
really
scared of uncertainty.
The next leg of this sell-off really started in the second half of last week and really accelerated on Friday. It was a brutal few days there, particularly Friday. Friday was an absolute and utter bloodbath for this market. And then we gapped down again this morning. It's related to tariffs. I mean, the truth of the matter is I don't think anyone knows what is going on with tariffs because the messaging seems like it changes every other day. And we know a couple things, though. We know, one, markets hate uncertainty. So constant changing of the message on who these are going to impact, where we're going to start, everything else is a heavy degree of uncertainty. But it seems like there's a lot of smart people out there now that are saying that April 2nd, which is our Tariff Liberation Day, is really like the end of the beginning. Where at a certain point, maybe a week ago, people were starting to think that, all right, well, April 2nd is finally the end. And we have our tariffs and we know where we stand. But it's looking more like it's the end of the beginning because all the tariffs are going to roll on, but maybe that kicks off the beginning of the negotiations that potentially bring us down. But one is that there's just a tremendous amount of uncertainty. And two is, that uncertainty stems around how bad these tariffs are going to look. It's as simple as this. Tariffs are high inflation, low growth policies. And every single time we see the administration come out and say something about increased tariffs, more tariffs, whatever, the market tanks. You can literally see it the second the announcement comes out, the market immediately starts going down. And every single time there is news on some degree of relief on tariffs, we get a big bounce back. And it's almost like there could be a tweet or whatever that comes out at any point in time from the administration that just rips us in one direction or the other. So trying to have an over understanding of the macro right now with so much uncertainty is nearly impossible. So we have to just really focus on our technicals. I had a couple great calls over the course of the last month and a half now on the big picture of the market. And I can set up the screen share here real quick and pull up the indexes.
Yeah, for sure.
We should be there.
Yep.
Cool. So, we had a couple really, really great calls, getting short at highs, buying this low. When we got into this 575 area, I had an upside target that SPYs could bounce back to 580. We went as high as 576, spot 40. So pretty good call, I would say, on where the bounce could get to, considering that I made that call when the market was trading in the 550s. We got pretty close to the upper band of kind of my target zone. I was able to de-risk into the up move, and then I started to get more and more market neutral as we got into this area. I started to reshort Tesla and reshort Palantir and reshort MSTR as I was unwinding the longs in this move. I wish I could have gotten just a little bit more upside, to be honest, because I would have been able to de-risk even a little bit further. But you know, can't be perfect to the penny in this business. Where I was wrong is that I thought if we got another wave lower, it would not happen with the same speed or ferocity as the initial down move. And I thought that we would be insulated with some underlying bid to this market in the late half of next week through this week. And I was very, very wrong on that on Wednesday, Thursday, Friday, really particularly on Friday. And I am super honest about my trading. And in the same way that I'm happy to give myself a pat on the back by just how phenomenally well I called out this short and I called out this long, I am also not happy to tell you, but honest in telling you that I got absolutely obliterated on Friday. I got out of all of the remainder of the shorts that I still had on pretty early in the day on Friday. So I had zero short exposure left for the majority of the down move. And then I started buying somewhat aggressively, really more looking for an intraday bounce back, especially in the middle of the day. And I just absolutely could not get it. The market on Friday was brutal. It was like one of the worst days I've seen in a long time. And we've been in a period of time recently of bad days. So I got absolutely smoked on Friday. Into the close on Friday, I was like, you know, there's just a lot of uncertainty right now over the course of this weekend. And I don't like selling stock into downside extension. It's basically a violation of my rule. But I was like, let me just take off a whole ton of long exposure here into the close, and I'll reassess that on Monday morning. I had actually a feeling that I was going to be rebuying my stock back at flat or even up this morning. Lo and behold, to my surprise, we actually had a really big gap down this morning. So that benefited me in some ways because I had taken off a lot of exposure into the close on Friday. And then when I was putting that exposure back on this morning, I wasn't putting it on at the equivalent of SPY 556 or above like I thought might happen. I was putting it back on at the equivalent of SPY 550 and below. So that worked out really well, though I did still keep some long swings over the weekend. So my P&L certainly took a hit into this gap down this morning. But then this is something that we bought. And it turns back to what I said a minute ago about respecting the technicals at the end of the day. So what do we have this morning? What's our setup? It's a day 4 gap down with extreme extension into support. And SPY had an ex-dividend in there, so that chart's a little bit off, but you can see it with the SPX, with the S&P cash. We basically gapped down to somewhere near your lows, or you can look at the NASDAQ, which actually gapped down below it, or you can look at the IWM, which kind of gapped down right to that support as well. So we gapped down to like a fairly major support level, actually the Q's gap beyond it, but we just had massive extension of the downside, and that's something I pay attention to. A day 4, I'm a big believer in doing like the day counting thing. I know Scott Ruther does that also. So day 4 gap down today, where we were at lows today. Low of the day is just under 547. The ADMA is at 563. So we had over $16 of downside extension from the ADMA on the SPY. And for reference, anything that's beyond $10, I consider to be extreme extension. So it's $16 of downside extension at lows today. That rivals some of the most maximum extension that we had on the downside throughout this entire fast correction period. The Qs at lows today were, let's see, the low of the day is 457 spot 33. The ADMA is just above 477. So the Qs gave us $20 of downside extension off the ADMA from the daily chart. That's also massively extreme. And again, this is on a day 4. Another indicator I pay attention to is the short-term tactical sentiment, which was all the way into the green zone, even as of Friday's close. They say that the green zone means buy. I actually usually say it doesn't mean buy. I usually say it means don't sell, don't short, and maybe buy. But that was an extra piece of information that was saying to buy. And then on top of that, we should have some supportive flows today. There's a huge pension rebalance, quarterly pension rebalance that's supposed to be happening by the end of this month. Well, guess what? Today's the last day of the month. It's the last day of the quarter. I haven't seen an updated number on that in a little while, but I'm expecting it should be about $30 billion worth of S&P to buy just off that rebalancing. There's also some supportive flows that are coming in from systematic funds, which not only were there no supportive flows on the systematic funds into this down move, they were heavy sellers, which was one of the reasons why I was so bearish into this initial down move, but actually less bearish into this secondary down move that we've been having, is because there is a whole huge source of supply that existed in this first down wave that does not exist in the second down wave. And not only does it not exist as supply, it's actually acting as a little bit of demand, not major, but a little bit of demand. And obviously everything helps. Yet the selling was so bad on Friday, particularly coming after the PCE and the University of Michigan numbers hit, that both seemed to point towards more stagflationary numbers. I'm actually still not calling for stagflation. I think that growth will slow down by enough to limit the amount of inflation that we get. But the read-through on those numbers on Friday was certainly towards stagflation. The market did not like it. It was able to overwhelm any forced buying that was out there. And we got this big down move. But like I was saying to the team in the morning meeting this morning, it's all right, I'm going to recognize, and I'll do it publicly because I have to do that, that I got smoked on Friday by buying too early. What I'm not going to do today into this gap down is have a complete flip of the switch and say, oh my God, I got so smoked on Friday, that means I need to sell all my longs and start short selling this market. That would be a complete violation of my rules. I do not sell into $16 to $20 of extension on SPY QQQ. And when it's a day 4 to the downside and short-term tactical is in the green zone, and there's some support that's out there from market dynamics, and the gap down is into support, not only do I not sell it, I buy it. So that's what we did. And then off the open today, we had a little bit of initial selling, but it led to this small hammer doji here on the 4th 5-minute candle of the day. That was the signal. At that time, I was like, all right, everybody, I think we can look to be long versus these lows. So, today I started buying a new position in the Qs represented through TQQQ. I started buying Meta down there. I started buying NVIDIA down there for bounce backs. I'm entirely out of that NVIDIA trade already. It was just kind of meant to be a day trade. For Meta, I'm looking for a little bit more. I'm looking for a bounce back in this thing to 580. That'll be a really good trade if it can get up there. Obviously, it's also meant to be a relatively shorter term trade for me. But this market has a massive amount of downside extension. That is something that I buy, but it's still a little bit tricky because we've got this huge thing of uncertainty looming over us, which is the tariff liberation day on Wednesday. And it's really hard to say exactly how that plays out. But my thought process is the more that we sell into it, the higher the probability that it does become a sell the rumor, buy the news type of situation. Whereas if we were still trading all the way up at 575 and the full tariffs came on, it actually could have potentially been the opposite. But now that we've sold so hard into this, obviously we'll see how we close today. We'll see how we trade tomorrow. But I am still expecting that this market has some degree of stabilization to it. I would not classify myself as a bull, but whenever you have $20 of downside extension or $16 of downside extension on a day 4 support, I'm almost always going to be a buyer on that.
All right. Good stuff. I want to talk to you about Tesla real quick. Tesla, obviously, been a stock that's been in focus throughout the entire Trump administration, of course, with Musk and Doge and all of the things. We do actually have some news coming up for Tesla this week. Q1 deliveries are set to be reported Wednesday. Market a little bit weary about those based on some of the stuff that's been happening with Tesla lately, but that'll be our first concrete number we're really going to get. What do you think about the stock here? We've rebounded about 3% from where we were earlier, but still down. So what do you think?
Sure. So I had called out a long, I think people know I bash on this stock a lot, but I was not afraid to call it a long when the setup is there. I called out a long on the 21st through 240 with a target of somewhere between 280 to 300. I didn't actually take that trade myself. I'm not buying Tesla, but that trade for the people who did take it, and it was called out in the VTF and with the team, and I think people were involved, was a phenomenal 3-day trade. And it's really as simple as this. When you get these bear market bounce back trades, which is not a bear market for the market, but it's certainly a bear market for Tesla. When you get these bear market bounce back trades, they can happen fast and furious. Tesla is a high beta stock. It gives a lot of movement. To think that Tesla is going to go from $480 to $100 straight down without giving a real bounce at any point along the way is crazy. If you're a short-term trader, day trader, swing trader, there are always opportunities to play both sides of stocks, regardless of what the bigger picture eventually does. In the exact same way that I just said, I'm not necessarily a big picture bull right now, but I am coming in and I'm buying the heck out of the market on a day 4 gap down. So that was a great long, got right back up to that 280 to 300 target I had, got up to 290 or so. And then into that day 3 to the upside, I started shorting. My short was a short-lived short. Try saying that 5 times fast. I was just looking for a quicker pullback, and I wanted to start to build into some shorts again. I shorted Tesla, I shorted Palantir, I shorted MSTR to have some short exposure on my books, just because big picture as we approached 580, I wanted to become more and more neutral. So Tesla is just a go-to for me to the short side. Look, the bottom line on Tesla is there will be great opportunities to make money long. There will be great opportunities to make money short, but you're still looking at a stock that's got a 140 or so PE multiple with 2024 revenue growth at under 1%, and the 2025 numbers aren't looking much better. They might even be looking worse. You're still looking at a company that has absolutely imploded from a brand perspective. And the only reason that this thing has been able to keep such a high multiple for such a long period of time was because of the brand. It was because of Elon Musk. I mean, we used to say that he was like the Iron Man guy, like that superhero. He was basically the living equivalent of that. And he's just completely imploded his brand. I've been saying the same thing over and over and over again. Look at the European numbers. They're imploding. EV sales are going up in Europe, but Tesla sales are going down at a massive rate. And the United States, I really try not to make my commentary political. I try to keep it to the stocks. But it's as simple as this. Just look at your friends and family around you. Most likely, anyone you know who is on the right, they are not buying electric vehicles. And anyone you know who is on the left who might buy an electric vehicle, they are not buying a Tesla. Then when you look at China, they can't compete in China. They can't compete from a cost perspective. They can't compete from a technology perspective. So what's the bull case for Tesla to be able to trade at a 140 PE when it's got declining growth just about at this point? Well, the bull case is what I honestly consider to be some pipe dreams that maybe work out and they maybe don't. Eventually, robotics is going to be probably really, really big business. Who is going to be the winner of robotics at this point? We have no idea. There's going to be so much competition in the space. Obviously, Tesla talks about it a lot, but will they come out as the winner? Maybe they will, maybe they won't. There's a lot of uncertainty. When you look at robo-taxis, which is the other thing that they really try to hype, maybe they come out as the winner. But I also, everything I see points to them not being the winner in that space because they just don't own the rails. Uber owns the rails, and Uber's partnered with Waymo. And that partnership is actually making steps forward where people can get on the Uber app. Pretty much everybody I know has the Uber app on their phone. And in certain cities, they can actually have a robo-taxi come and pick them up. I haven't heard of any Tesla taxi app or anything like that is going to have a robo-taxi from Tesla come and pick me up. So it seems to me that they're losing in that space. The robotic space, who the heck knows? It's so far away at this point. And their core business is a disaster if the stock itself is extremely expensive. I don't want anything to do with owning the stock for more than a trade. And again, there will be great trades that are out there. That trade from 240 to 290 on a 3-day move is awesome. But beyond that, I am out on this stock. I think it's too expensive. There's just way better things out there that you can own.
All right. So we know the focus of the beginning of this week, of course, through Wednesday really, is on tariffs. But in addition to tariffs this week, we're also getting new labor market data. We'll get the private payrolls report on Wednesday. We'll get the official labor market jobs report on Friday. And these numbers, I think, are definitely even more in focus now for the market post-Fed meeting and them saying, they're data dependent again, and we just don't know how many rate cuts, basically, even though they show two. Really, the market doesn't know. What are you focused on for the jobs numbers this week? Do you think the tariff deadline is overshadowing some of this importance?
I don't know if it's overshadowing it. I think that the employment numbers are becoming increasingly important again. For a while, it was like, sure, we're paying attention to employment, but CPI was the most important number for the entirety of the stock market. Now, CPI is obviously still important. It definitely is, but I think it's getting slightly less important as numbers that are showing us more of the strength of the economy are becoming more important, particularly employment-related numbers. We are at a point here where the narrative is good news and bad news is bad news, right? That's a narrative that changes sometimes depending on expectations of what the Fed might do and when they might do it. But right now, with the Fed basically saying that they are kind of in wait and see mode, though technically they're going to start giving us a little bit of easing here starting on April 1st with the roll off of the balance sheet that they've been doing. Just broadly speaking, unemployment's becoming increasingly important because that's one of the main read-throughs on, are we actually seeing an economic slowdown or not? And at some point, I don't think it'll be seen in the numbers this week, but at some point, maybe the next couple of months, we will begin to see the government layoff numbers start to trickle into the employment numbers, and we'll begin to see what the secondary effects are of that. We'll begin to see if it does lead to a growth slowdown or not. So yeah, the employment numbers are becoming increasingly important again, and good news should be good news, and bad news is bad news until the Fed signals that they are ready to start to step in further.
All right, good subject. All right, talk me through some of the setups that you like in this market. It's been an interesting market for sure. Definitely a trader's market, and more very much, I would say, a lot of a day trader's market, not even just a swing trader. So it's been tough for some people. So what are you looking at for where we're at?
You have to be really tactical in this market right now. I like, in this very moment, I like longs still. I like them even more this morning when we were gapping down and we were trading $7 lower or whatever in the SPYs. But I like longs still right now. April is a month of generally strong seasonality. There should be, and I've been saying this for a few days and obviously got hurt a little bit at the end of last week from this thought process, but I still stand by. I think that there should be some degree of underlying bid to this market right now, where I know that this sell-off was very, very fast back down to these New Year lows. But I do think, broadly speaking, if we were to continue down, if our 10% correction in the market becomes a 15% correction in the market or becomes a bear market, I think it's a little bit more of a slower move down than what we initially saw from mid-February to mid-March, or what we saw late last week through this morning, just because the flow dynamics are different. In this initial wave lower, there was everyone to sell and no one to buy. You had selling that was coming from pretty much everything except for retail. Retail was still buyers in the way down, and except for corporates from their own buybacks. And that is always some degree of a buy flow, though it lessens in the blackout window around earnings season and then increases when earnings season ends and they're in between being able to report. But the big sellers that were coming from the systematics, from the CTAs as an example, they don't really have anything left to sell. And as a matter of fact, they're short. So the risk on the CTAs actually goes to the upside. The vol control funds, as we start to roll off some of the bigger realized vol movements from here, are potentially a source of demand as well if we can ever get some quieter realized vol days today. Maybe even today. I mean, SPYs are only down 0.35% right now. That could lead to a bigger underlying bid that comes from them. So I wouldn't say that I'm bullish, but I'm not like a huge bear like I was for this initial move. Though if we continue to see, I mean, what really killed us on Friday, what was able to overwhelm the underlying demand dynamics of this market that are just kind of moderate at this point, was bad economic numbers. So that's the biggest thing to pay attention to on whether or not we're going lower, is what does this now begin? What do tariffs, what does getting rid of cheap labor in the US, and what does government austerity do to growth? We're going to see that in the economic numbers, and then you need to combine that with what does the Fed do. That's going to really dictate, I think, where we go from here. And if the numbers are really bad, you can see what we saw on Wednesday, Thursday, Friday. It can happen. That panic selling from stagflationary numbers can overwhelm the demand. But barring really bad economic numbers, I think that we see just generally more stabilization going forward. So what does that mean now from a trading perspective? To directly answer your question, it means you have to be tactical. So I am a big believer in studying market extension. And that was one of a few things that led to us really beginning to buy off this initial low. It's another thing that led to us not panicking into the gap down today and thinking that the world is ending, but actually saying, all right, this is where we tactically buy. And that worked. So I wish I had a better answer for you, but I just feel like it's so day to day. It's like every morning, all right, what are the latest headlines? Where are we gapping to? And what is the appropriate game plan and analysis based on where we're gapping, how we're trending, and how we're trading? And then we, take it from there. And the final thing I would say is everything I'm doing right now is starting from the index level. The index are so important. Analyze the index first. Which way is the market most likely going to be moving technically? And then move into the stocks that you would potentially want to buy or sell.
All right. So not a lot of ideas. Hard market to have long-term ideas in for sure, I think. But Derrick, as you mentioned, is preparing on a daily basis every single morning, doing that with his team there in the ProDesk virtual trading floor. They get all his insights every single day. All right, Derrick is a real trader. I'm going to let him get back to that. But if you'd like to get his free ebook on prop trading and the benefits and possibly work with Derrick himself, go to t3live.com/do live. Again, that's t3live.com/do live to get Derrick's free ebook. Derrick, have a great week. I know our audience will get a check-in with you midweek, so maybe you'll have some different thoughts to share after the tariff deadline happens. So everyone look forward to that on a Wednesday. Derrick will be back with Mike and the rest of the roundtable. So Derrick, have a good week. Talk to you next week.
Thanks, Greta. See you next time.